Imagine predicting the exact trajectory of gold over an entire decade. You nail the macro trend. You are 100% correct about the destination, and yet your trading account is completely wiped out. It is a maddening experience. You do the research, you spot the pattern, the asset does exactly what you thought it would do, and you still end up losing money. You are perfectly right, but practically ruined. The belief driving this frustration is held by almost everyone in the markets. Gold favors momentum. It supposedly provides an easy, guaranteed trend to ride. The obvious conclusion for most people is to build a simple, long-only trend-following system and collect their money. This chart shows gold's macro trend over the last decade, and the baseline truth is very real. A 10-year quantitative study revealed that if you tested a completely random entry strategy, literally just throwing darts at a board to buy during upward daily trends, it returned a profit factor of 1.50. For every dollar risked, the system returned $1.50. That natural upward drift, that gravity pulling the price higher over the span of years, is mathematically proven. The market truly does want to climb higher. But that gravity traps people. A mathematical tendency gets packaged into a curated marketing illusion. It tricks retail traders into believing the market is a simple set-and-forget escalator, hiding the deeply flawed assumption that a true macro trend automatically translates into a tradable rule. To see how that illusion breaks down, we have to shift from the smooth monthly view to the granular reality of the hourly charts. The study analyzed over 64,000 hourly data points, using ultra-precise mid-price data to strip away broker spread manipulation and isolate pure price action. The researchers tested 5 different, fully sampled trend models on this microscopic level: momentum models, pullback models, breakout systems. Out of those 5 models, 0 out of 5 beat the random dart-throwing baseline. This isolated line chart breaks down exactly why those trades die. The researchers tracked a metric called adverse heat. Across the tested models, a staggering 87% of trades were stopped out before the trend actually paid out. These traders used a 1.5 average true range stop, which is historically quite generous. The stops aren't inherently wrong. They simply sit entirely inside gold's normal everyday market noise. Markets do not move in clean lines because the fuel that drives them, liquidity, doesn't sit in clean lines. Algorithmic systems and large institutional players constantly hunt for the liquidity required to fill massive orders, and that liquidity pools right at the obvious technical levels. It sits exactly where retail traders place those logical, generous stop losses. The microscopic path is engineered by massive players to sweep levels. It inflicts maximum financial pain, triggering your risk management stop and then rockets without you. If the execution path is this brutal and nearly 9 out of 10 trades fail, how do trend-following systems maintain their legendary reputation for printing money? The answer lies in this year-by-year breakdown, which exposes what the researchers call the era concentration trap. Looking at the full decade of data, the illusion of a robust all-weather system shatters completely. The entire positive return for the decade came from just a single 36-month window. From 2023 through 2025, they generated 59 units of return. But if you strip out those 3 golden years, the strategies bled a devastating negative 52 units of return across the rest of the decade. Relentless, record-breaking gold accumulation by global central banks created a temporary macroeconomic anomaly during those 3 years. When you introduce that level of price-insensitive buying, it physically absorbs the liquidity hunts. It temporarily overrides the standard intraday noise, dropping the adverse heat and making the execution path artificially clean. Assuming those 3 years will repeat indefinitely is a blind bet on a temporary market regime. You are mistaking an incredibly lucky summer for a permanent structural edge in the market. The absolute core lesson of the massive dataset is simple. If the execution path is not survivable, the ultimate direction does not matter. There is a massive, agonizing gap between a trade being eventually correct on a paper chart and being actually tradable with real money in a live account. This visual shows the author's open-source solution to combat beautifully curated marketing illusions. They call it the eyeball path. It's a challenge to manually verify the pain of the market. Pull up a 1-hour gold chart on your own screen. Find the last 10 clean, obvious breakouts to new highs. Take a drawing tool and manually measure how far the price dug against you before it finally paid out. You will see the mechanical reality with your own eyes. Consider how this same structural volatility shows up in long-term life goals or career trajectories. Obvious trends can still be unsurvivable if the daily path shakes you out before you arrive. Data replaces a comforting myth with the clarity required to navigate the market's behavior. You finally stop fighting the noise and start surviving the journey.